So please start working on that. So we are going to look at the chapter 3. Now on chapter 1, if you remember chapter 1, we look at the different way or how to calculate the goodwill using the steps that we have to go through in order to determine the goodwill. And then on chapter 2, we also test the goodwill, and also we did a journal entry when the company or when the parent company acquired the the subsidiary company. We are now going to look at the consolidated financial statement at the initial acquisition date. The day the company acquired the company or parent company purchase or acquire the subsidiary company. What are the journal entries that it will be done? Then on chapter 4, we are going to look at the journal entry after the initial purchase, after the company purchase the company. The next year, the following year, what will be the consolidated account we have to prepare, and also the journal entry we have to do. So we are first going to look at the different definition of the word subsidiary and controlling. Even though I know we have gone through it on the chapter 1 or 2, we mentioned the parent company. We also mentioned a subsidiary company. So what is parent company? A parent company is a company that control the other company or have an interest in another company, right? So it's a company that has controlling interest in another company, giving it control of its operation. Controlling interest is defined as the portion of the equity, and that's where it's good here. Portion of the equity of the consolidated group attributable to the parent company. So we are talking about a part of the ownership that the parent company have in the world in their subsidiary companies. For example, if Apple purchase another company, maybe let us assume that Yahoo or TikTok. Now, the percentage that the Apple have in that is honored as the parent company. Now, the parent company means that they control the company, but it depends on the level of control that they have before we can consolidate the two accounts together. Then we have the subsidiary company. It's a company that's completely or partially owned by another company or owned by the parent company. That one we are the subsidiary company. So the parent company is there, and you are under the subsidiary companies. You are under the subsidiary companies. Control is always depend on the level of the control that the parent company have. Because the control is the possession of direct or indirect of the power that to direct the management and also policies of another entity, whether through the ownership of the voting share or by the contract or otherwise. Control simply means that somebody is controlling the subsidiary company, and that's the parent company. The control include the mangle of the decisions and the policies of the management. So most of the policies should be approved by the parent company before the subsidiary company can do. They cannot just say, "Oh, we are a company," even though we are owned by the Apple or we are under the Apple because Apple have maybe 90% or 80% control. So we can do whatever you want to do. No, decisions should pass through the parent company. The parent company have to approve the decision before they can carry on the decision. Non-controlling interests also occur the part of the company that is owned by outsiders. Part of the subsidiary company that is owned by outsiders is known as the subsidiary non-controlling interest. If you remember before the 2007 on chapter 2, we talk about it that it used to be called the minority interest. Now it's called the non-controlling interest. Remaining percentage or the shares of any remaining that stock in the subsidiary company that belong to the parent company, the outsiders, is known as the word non-controlling. So, for example, if Apple own about 90% of TikTok, it simply means that the 10% belong to the non-controlling interest. So, when the subsidiary gets net income or they declare the dividend or anything like that, it simply means that the non-controller has the 10% of every income, dividend, or net income of the subsidiary company. Now, the purpose of preparing the consolidated accounts is to present the operation of the financial position and the income statement of the two company as one company, as one company. So as one economic entity. The main objective of consolidation is to provide the most meaningful presentation possible of the financial statement of the two companies. Now, circumstances when majority owned should be excluded. Sometimes the parent company can have a control. They can have the subsidiaries, but there's exceptions to that. Meaning that those exceptions are you cannot include them in your consolidated account. One, if the company filed for the bankruptcy, you cannot include them on your consolidated account. Two, control does not rest with the majority. For example, subsidiary company in legal reorganization or bankruptcy should not be consolidated if they file for bankruptcy or they are reorganizing the company, even though you own the majority of the company's shares or you own the majority of the company, still you cannot consolidate the company because of the position that they are in. Another one is that if the company is under the governmental imposed uncertainty, if the company have done something wrong, legally wrong, and maybe they are under investigation by government is investigating them, you cannot do that. And also, if the solicitor is residing in a country where the foreign exchange restriction and control of the government exists, you cannot consolidate them. You cannot consolidate the account, even though you have the majority share, right, of the company. You own the company, but still you cannot do that. So what are some of the reasons for the subsidiary companies? There are several advantages of acquiring a control interest in the voting of the another company. One, you can go to the stock acquisition. It's relatively simple, right? It's not a difficult way. Maybe Apple want to buy the TikTok, or maybe they want to take over and they say, you know what, we don't want to go to struggle where we have a meetings and the negotiations between the board of directors and etc. to convince them to join our company or to buy the company. Apple can just go to the market, buy the stocks of the TikTok company. If in the open market they buy the stock and they own the majority of the stock, it means that they are now the owners. They now control the TikTok. It's a sub company. So such acquisition avoid the over lengthy and difficult negotiation, like I was saying. They don't want to go through all this struggle to convince the TikTok managers or the board of directors. We can just go to the market, buy the shares. When you acquire the more of the shares, you become the owner of the company. Control of the subsidiary operation can be accomplished with much smaller investment since not all the stock are needed to be acquired. You can acquire or maybe invest small of the company stocks, and right away you become one of the owner, or you own the company. You can own the company. Now, so let's talk about the stock acquisition. If the company decided to buy the stocks of the company in order to consolidate the accounts. Example here, if A plus B, A by the B here, they can consolidate the two accounts. together, and they can prepare the what consolidated account, which means that A and B are together. So company A acquired the common stock of the company B. Simply means that we are going to debit the investment. Investment here is the money you are investing in the company. The money you are investing in the company, right? Debit the investment in the B company. Credit the what you are giving up. We all know you can give cash, you can give the common stock, right? But mostly here you got give some of the common stock, or some of them can be also be the in terms of giving them the how do you call it, the cash. So it's all depend on what you are giving them. Now, when you are preparing consolidated account, you have to prepare something called the working paper. Working paper is like a mirror that will direct you to in order to prepare the consolidated account. So necessary to get a consolidated account. As a matter of fact, now you are going to hear a lot of something known as implied value. You guys are going to hear the word implied value here. We are going to talk about this a lot as the implied value as we move on. Because on the working paper, you are crossing, eliminating any intercompany transactions. We are going to eliminate any intercompany transaction before you can prepare the consolidated, and it's done through the working paper. We do that through the working paper in order to eliminate any intercompany transaction. Now, so for example, here, if you look at this company, P company purchased 100%. Once the company purchases 100%, it means that there's no non-controlling. There's no non-controlling. They purchase 100% of the subsidiary stocks or their asset. So purchase 100% of the common stock of S company by issuing 4,000 share of 8 P par value of $10. The market value at that time is $17. So they are getting extra capital. They are going to get extra capital because the par value, the market value of the share exceed the par value. Also, P company incurred a cash of the 20,000 for the registering and issuing the common stock. We talk about that one in the chapter 2, if you guys remember. Also, assume that P company pay an additional 10,000 for the finder, which the money will go directly to the person who find the company. The stock equity section of the balance sheets were as follows. So before the consolidated account, or before the P company purchase, P common stock here is $350 with the $10 par value. So, for example, if you want to know the number of the shares, we just divide the 350 by 10, while the subsidiary company, S company, is over 320. Both of them have the other contributor capital and the retained earnings here. Please. This one here, when we are preparing the working paper, we don't care this one here. This amount here, we don't care about this when we are preparing the balance sheet, because we are acquiring all the common stocks and it related everything. So what we are going to do is that we are going to eliminate the common stock of the S company, eliminate the other contributor capital, and eliminate the retained earnings. This here should be equal. It has to be equal to our investment. In other words, we are going to eliminate it. We are going to eliminate this one according to the investment that we have in the company. And that is what now you are going to see, the elimination process. We have to eliminate the word equity against the investment. We are going to eliminate the equity against the investment of the subsidiary company. So first, prepare the journal entry of the P to record the purchase of the common stock, and also 8 expenses. So we are going to debit the investment here. Investment, why this? Because we issue 40,000 shares The market value is a what? For 17.50. So we invested or we purchased, we give for 700,000. The 700,000 here must equal. Remember, our investment that we are giving 10,000 of our par value, we give out the what? 400,000. The rest is the word that go to the word other contributed capital with the extra money we are getting, which is the 17.5 minus 10 times the 40,000 shares, or just the difference between your what? Your debit and the credit. The company said they incur other. One is the what? They find 10,000 was paid for the finder, and we incur another cash of 20,000 for registering of that. So we debit the other contributed capital. Professional fee is a professional fee like accountant, and this one, we did this one on chapter 2. So we separate them. Now, let's look at the P as another example here. They have the P company or the software company have the account receivable, they have the what inventory, they have the what equipment. They own the 100,000, they have the common stock of the what 200,000 retained earnings of this. Now, assumption here, book value of the asset liability represent the fair value. So assuming that the book value of everything here represent the fair value in the market. Now, the fair value of the net asset is a 500,000, according to the price paid equal to the fair value of the net asset. Therefore, we are investing in the company 500. We are giving them the 500,000 here. Please, we have to eliminate this 500. We are going to do that, but we have to eliminate this one here because it is our company. We are going to consolidate the account. So it's like an intercompany transaction. So we have to eliminate this investment here against, we are going to eliminate against these two here. The common stock of S company will be eliminated. The retained earnings of S stock will be eliminated. So in our elimination working paper, here, we are going to debit the common stock of S company, debit the retained earnings of S company, and then credit our investment to eliminate our investment in the company because we have to eliminate them, iron them out. You cannot, your investment had to be eliminated before the consolidated account. The typical example is like you and your maybe you and your husband. Your money is your husband money. Your husband money is your money. So if you take money from the bank account of your husband, both of you is your money. So before we want to know the actual money, we have to eliminate any amount that is what in between there before we can get a good amount. So here the common stock here is 200,000 will be debit. The retained earnings of the 300,000 will be debit. Then we are going to eliminate the 500, which is our investment here. We are going to eliminate them. That's the first step in the elimination or process. We are going to eliminate our investment against the equity of the subsidiary company. Why this one is the word equal? Because there's no non-controlling interest. There's no non-controlling interest. So whatever you paid is equal to your word, the equity of the company. Now, this is how prepare the consolidated account before this how the elimination process is. One, we are going to eliminate the parent company account. We are going to eliminate the investment of in the subsidiary company against the equity of the subsidiary. That's one I just did. So you are going to take the investment, your investment that you invest here in the company of the S company, and then eliminate against the equity of the S company, equity, which include the following. One is the common stock of the S, other contributed capital of the S, and the retained earnings of the S company. These are the equity of the subsidiary company. We are going to eliminate it against the investment of the in that company. Investment in that company. Any question before I move on? Any question? Guys, the floor is open. Any questions? Any question? Are you guys here? Any questions? Any? Why today you guys are so quiet? Any question, please? Anyone has any questions? Any? Can you guys hear me? Or you can't hear me? Oh, because I have not marked the test. Forget about the test now. The test is gone. You have done it. It needs to be marked. So forget about that. Don't think about the test. So we have to eliminate that. So any intercompany receivable will be eliminated against the word intercompany payable of the word there. So it simply means that if A is owing B, the parent company is owing B, we have to eliminate them. How can this happen? For example, let's assume that A, right, I'm going to put here, we have the parent company, we have the subsidiary company. Let's assume that parent company here sold merchandise to the S company. So in the books of the parent company, they are selling the merchandise. So they are going to debit the account receivable here of the S company and carry the sales. That's what is happening here, right? Then the S company who is buying the goods is going to debit the purchases here and carry the account payable that they are owing the parent company. These transactions are the intercompany transactions. It's intercompany transaction. So therefore, at the end of the day, before we prepare the consolidated account, we have to eliminate them. And to do the elimination, we are going to debit. This one is debit, therefore we are going to debit account payable here. So account payable here will be debit, account receivable here will be credit. So let's assume the sale is $100. $100 here, $100 and the $100. We are going to debit the $100 of the account payable, account receivable, $100. Once this is done, this account cancel this one. Somebody will say, wait a minute, what about the sales? On chapter 4, we are going to eliminate the sales here against the purchases on chapter 4 because it's intercompany transactions. So it should be eliminated before we prepare the consolidated accounts. We also have to eliminate any advance payment. If the parent company give cash advance to the subsidiary company, we have to eliminate them. We are going to eliminate it. If interest revenue will be eliminated against the interest expenses here. For example, let's assume that the parent company or the subsidiary company give a loan. They give out a loan to their parent company, and the parent company have to pay interest. When the interest is received, this is what happened here. When the interest is received on the book of the parent company and S company, parent company are paying the interest, so they are going to debit interest expenses and credit cash here because they are paying. The subsidiary company are receiving cash, so they are going to debit the cash and carry the interest revenue here. This revenue here have to be cancelled out. We have to eliminate these two. So we are going to debit the interest revenue and carry the word interest expenses to eliminate the word intercompany revenue against the word intercompany expenses here. Dividend revenue. We are going to see, you guys are going to see this on chapter 4 about the dividend revenue. Parent companies sometimes will pay the dividend. It depends. When they pay the dividend, we are going to eliminate the dividend receivable revenue against the dividend that is declared. Management fees received also should be eliminated against the management fees paid to the parent company. Sales to subsidiary purchases here will be eliminated on chapter 4. We are going to do this one. We are going to eliminate it. So all these eliminations will be done before we finally prepare the consolidated account. How do we eliminate the investment? And I've already, since the beginning, I've already said it already. We are going to eliminate the investment against the equity. And it depends on, this is what I said before. It all depends on what I told you guys before here, that implied value here will determine whether we own the 100% of the parent company or we own less than the 100% of the company. That will determine the elimination process. That will determine the elimination process here. So for example here, if the implied value of the subsidiary company equity is equal to the acquisition price or the percentage that is acquired, then we say, wait a minute, let's see if there is a non-controlling interest. So we are going to use two cases here. One, if the implied value here, IV of the subsidiary company, is equal to the book value of the subsidiary company, we say that the parent company acquired 100% of the company. Therefore, there is no non-controlling interest. If the implied value of the subsidiary exceed the book value of the subsidiary, which the implied value here is greater than the book value, two things can happen. It means that the parent company acquired 100% or the parent company acquired less than 100%. We are going to solve problems related to all these cases. Now, the last case, if the implied value is is less than the book value, it can also mean that the parent company can acquire 100% of the company, or they can acquire less than the 100% of the company. So let's look at a case here. Assume that the implied value of the subsidiary company is equal to the book value of the subsidiary company. What does it mean? Now, it means that what the implied value, the value of the company is equal to what you pay for. That's what it means. The value of the company is 1 million. You pay for 1 million. So they all implied value equal to to the same amount as the book value. So let's look at an example here. Assuming that on the January 1, P company acquired all the outstanding stock of the S company. So which means that they acquire all the 10,000, no non-controlling interest. And let's assume that they paid 160 to get the company. So one, we have to debit the investment the day we buy it and carry the cash. This investment here at the end of the year, before we prepare the consolidated, we have to eliminate this investment here. We have to eliminate this investment here against the equity of the S company. Against the equity of the S company. We have to eliminate them. We have to eliminate them. So if you look at the question they're asking here, that assume that the balance sheet of the two companies after the acquisition as follows. You see here, before, this is what all of them stand here. P company have a cash, S company have a cash, other current assets, 280, 100,000, plant and equipment 240, 80,000, land 80,000, 40,000, investment. So you see here, they invested 60,000 here, and this is what I want to draw more. 60,000 investment here. We are going to eliminate this one. We are eliminating the cancel it out because it's parent company money given to the subsidiary company. So we are going to eliminate this one against the equity. These are the equity. We have the equity here against these three equity of the subsidiary company. So in other words, remember here, this investment was credit, debit. Now we are going to credit our investment here because we are eliminating it. So our investment in S here of the 160 will be credited. Once we credit, this is gone. Now we have to what? Eliminate this investment against the what? The equity of the subsidiary company, which consists of the common stock. Their common stock here is 100,000. Their other contributor capital OCC here is amounting to 20,000. And lastly, their retained earnings. S retained earning is a what? The 40,000 here. 40. So you can see that your debit is 160, your credit is 160 because the implied value is equal to the book value here, because the implied value here is equal to the book value. So the price you paid is 100,000 divided by the implied value. That gives you the what? 160. The book value is also what? 160. So there's no difference here because you acquired the what? 100% of the what? The company equity. You acquired 100% of the what? The company equity. So now the ownership, the working paper to consolidate the balance sheet. So you see, after the balance, we have to eliminate, and this is how we are going to do it here. So here we cannot eliminate the cash, so there's nothing. So there is 80,000. We don't eliminate the account receivable, so nothing. You add the two numbers, 380. We cannot eliminate the PPE, so we did not eliminate the same amount. Land, no elimination, 120. Investment here, we are going to eliminate this investment here very soon. On a consolidated here, even though you see it here, but we are going to eliminate this one soon. Then, so on our consolidated, we have the other contributor capital. You see this, we added, this is our 500,000. That is before the elimination. We have not done the elimination yet. This is what is going to happen now. Now we have to, before we prepare the actual consolidated account, this is what I did. If you guys remember, we have to eliminate investment. We have to eliminate this against the what? The working paper here. This is done. The work paper is only one entry because we are just eliminating the investment. So once the investment is eliminated, we are going to have a new consolidated account. And this is what is going to happen now. Now the common stock here, this has been eliminated. So now it's only 400,000 here. It's only 400,000. Other contributed, we have eliminated this. So this is going to be 400,000 here after the elimination. This is going to be the same 220,000. We are going to eliminate this one. So this is gone. The retained earnings, we just need only the 80,000 because we have eliminated the what? The 20,000. This one is gone, so we have only 200,000 here. And when you add them, it has to be equal. It has to balance. When you add this is gone. So when you add everything here, it should be equal to this one because you have eliminated the word intercompany transaction. You have eliminated the investment against the word the equity of the company, against the equity of the company. Let's look at example 2 here. Assuming that this company acquired all the outstanding stock and they pay 80,000. So we debit the original investment, we credit the cash we gave. Let's assume that this is the balance sheet before the elimination. The balance sheet for the both company immediately after the acquisition. Now, this always pay attention. This is the equity. We have to eliminate these three here. We are going to eliminate this 3 here. And this 3 here should be equal to the amount that we invested, which is 80,000. That's why if you look at the amount that you invested, is a what? Is 80,000. So we are going to debit the common stock, other contributed, retained earnings, and we eliminate the investment. Now, after the working paper, after that, if you want to, this is what is going to happen here. This one here, we are going to add this one here. This one here is going to be 40,000. Now, other contributed capital here, because you are not eliminating anything here. This one is going to be, those with the, I think it's 190. Somebody can check for me, please. 190,000. Plant and equipment, we are not eliminating the plant and equipment. So nothing here, you are not eliminating anything here. So the amount here is going to be 160,000. 160,000 here. Land, we are not eliminating the land. So the land is equal to amount of the 60,000. We are eliminating this one here. So we are going to credit investment here, 80,000. Therefore, this is the word. It's gone. We have eliminated it. Now, I want somebody to add the asset for us. If somebody I don't know, today you guys are not in the mood, but please be in the mood for me. Let's see. This one is 100, 200, 300. Is it 450? This is what I have. Somebody can check it for me if it's 450. Somebody can check for. It's good? Mm-hmm. Okay, thank you. Now, we are not eliminating we are owing 110. Both of them together is 110 is the amount they are owing. The common stock here, this one we are going to eliminate. So we are going to debit 50,000 here. And that's what we did here. I'm using what we did here. And then we are going to debit the 10,000 here of the other contributed capital. We are going to debit the retained earnings of the 20,000. So if this one will cancel this, so the common stock is a 200,000 from the parent company. Other contributed capital is 40,000 from the parent company. Then we have the retained earnings here is 100,000 from the parent company. I want somebody to add the numbers for us and see how much we have here. This should be equal to the same 450. I think, yes. I think it's the same, 450. So we have eliminated. So in your elimination, the total here for the elimination, you're going to put here the total balance here. This one is 80,000. This side is also 80,000. And then, of course, we have the total of the consolidated amount, which is also the total at that. Let me see. Come on. Amount of the 80,000. Of the 80,000. B, what if, right? B said, what if the parent company investment is equal to the book value? Subsidiary company acquired here, but they own the partial, meaning that they don't own the 100% of the company. So the parent company acquired 90, and this is what I want you to. So it means this is what it means. S company is 100%, but parent company own 90. Yes, go ahead. Somebody's hand is up, or is it my hand? Can my hand be up? Hold on. By mistake. So the 10% here is equal to non-control. Non-control here have the what? The 10%. They have the what? Less than. So they have the 10% goes to the what? To the non-controlling. Give me 1 second. Why my hand is up? 20. Maybe when I was writing that side and then something. Okay. Oh, I have to take this first. Mhm. Oh, okay. It's okay. Let's ignore that. So 10% belong to the what? To the outsiders. So one, you have to calculate the implied value because you paid this up. So the question is, how much the actual value of the company? That's what we mean by the implied value. How much is the actual value of the company? And the formula for the IV, implied value, is equal to the price or the consideration, the money you paid divided by the percentage that the parent company have. So in this case, if you want to know the actual value of the company, it's going to be 144. Somebody should help me out. Divided by 0.90. So how much is the implied value of the company? Meaning how much the actual value of this company? How much the actual value of the company? That's what we mean by the implied value. The actual value of the company.
I got 160,000.
Thank you. So the value of the company is 160,000, which means that the 160,000 here with the value of the company, 144 was contributed by the parent company, which had the 90%. And then non-controlling interest will be the different, I think, if I'm not mistaken, is it 26? No, I think it's 16,000, right? 16,000, which is the 10%. I'm going to stop here because it's very important. You have to know how to, from now going to the end of chapter 7, we always have to calculate the implied value. We always have to calculate the implied value and know how much money was contributed by the parent company and how much of that investment belonged to the outsiders. And the formula for the implied value is the payment you paid divided by the what? The percentage of the parent company. So any question before I continue? Any? Okay. I know once we start solving the questions, problems, maybe your questions will come. So here, you see, we have to eliminate the investment. We have to create the non-controlling interest. So we eliminate the what? The common stock, other contributed, retained earnings, 144. We create the non-controlling interest with the 10%. This is the 10% of the implied value. 0.10 times the what? 160,000. That give out the what? The 16,000 as the what? The implied value. I want us to solve at least one or two questions before we leave the class today, so that we get more understanding of this chapter here. So if you look at the first, yes, go ahead.
Going back for like 1 minute, let me just go back to the previous table.
Okay. Give me 1 second. The people, okay, good. Here, right? This one?
It's the one before. The one before that we were working.
The top one? I talk about this one?
Yeah, that's fine. Thank you so much.
Okay. So let's go back and do at least one or two exercise. Then, so if you look at the exercise that we have here, the first exercise here, this company here, so prepare the journal entry to eliminate the word pence company investment in the D company preparation before they prepare the consolidated account. So they are giving you a what if. So they are giving you two options here. So assuming that P company A, they own the what 100% and they invested 175,500, right? The common stock of the S company is the what 80,000. Other contributed capital 46,000. The retained earnings 21,500. That is A. B, if they own only 90%, which means that non-controlling interest is there because they own less than the 100%. So let's do the first one here. You first one, let's prepare the what? The investment here. Any difference? See if there's any difference, the difference between them should go to the what? Equipment. Should be attributed to the equipment. So A, I will do the first investment. A said that they invest. So we are going to debit the what? Our investment. And we are investment in the what? S company. And we are going to carry the what? The cash. That's what we are doing in the beginning. You are debiting the investment amount of the what? You invested 175,500. You are giving cash of 175,500. So that is what you are paying. Oh, sorry, 175,500 here. Now, two, do the working paper to eliminate this amount. So one, we are going to eliminate the what? Debit the common stock in S company. The common stock of S company is 80,000. We are going to eliminate the what? The other contributed capital in S of S company, which is amounted to 46,000. We are going to eliminate the what? The retained earnings of S company, which is 21,500. We are going to credit our investment. Our investment in S company, which is the 175,500. So you can see that your debit here, let's add this one and see. This is equal to sum. Your debit here, why did I get? There's a difference, if you look at here, there's a difference of here. Your debit here is not equal. And the is there any difference between the book value? Mean that if there's any difference between your implied value and the book value, because the implied value here should be equal. But if you look at it, 80,000, 46,000, 35, we pay this amount. This side here, let me add the sum here. Is equal to the 140, which means that the debit side here is less than the credit side. And that's why they say if there's any difference between the net asset and the value implied by the book value, it attributed to the what? To the property and equipment. So here we are going to, I'm going to take this, bring it here, and I'm going to put here, they say if there's any difference here, it should be put a PPE. So I'm going to write the word plant and equipment, plant and equipment at the price of PPE. So plant property and equipment. which is going to be the difference between the what them. So 80,000, and now somebody can do the difference for me. If you subtract this from this, I don't know how much we get. Let me see if I can do it. This is equals to this. Take out this one. I hope so. 28,000. Now I can clear this one, but if I clear it, it will go. This is 28,000. We know it's 28,000. The difference is 28,000. Now, B said, look at the B here. You invested, so you can still do the first journal entry. I will just change it here. We invested 116,000. 116,000. The first thing you have to do is that you have to determine I'm going to imply value here, which is equal to the 116,000 divided by the percentage, which is the 0.90. Those to the calculator. How much is the implied value here? How much is the implied value? How much is the implied value? Anyone? How much is the implied value?
128,888.
18888, like this, right? Good.
Yes.
So
Yeah.
this one, we know out of this one, 116 belong to the parent company. So how much of this belong with the 10%? 10% of this belong to the what? Non-controlling interest. So how much the 10%? How much the 10% of 12888 times 0.10? I don't know. Verify for me. I have 12,889. Am I right?
Yeah.
Good. Once you get this one, you can now do the journal entry. So now in our elimination paper here, we need all this. I need all this here. I'm going to take out everything here, put it here. Let's see, please. Okay, good. I'm just going to change number. This one is not yet. This is not good. This is 116,000. Then we are going to put here what? Non-controlling interest. Non-controlling interest. And we just calculated the non-controlling interest here at the amount 116, amount of the word 112,889. Therefore, what is the PPE here? What is this amount here? This amount, you can add this side, which we know, I think 140 something or so. So this one, you can add this amount here, and then add these two amounts, then you subtract from it. You subtract. So I want one person I'm going to add a debit side, 80,000. I have 80,000 plus 46,000 plus 21,500. I have 147,500. I'm going to now subtract it from the word 116,000 plus 12,889, which is 128,888 as 889 here. So minus 147,500 here. The implied value that I have on the B part here, 116. Oh, the retained earnings here is on the credit side because it's a negative. So let's move the retained earnings here. We can move let me see. I will just take this one, put it here. put the retain. Earnings here in the what? In the S company. 21,500 because it's a negative. Retain earning is a negative here. So the difference here is 10,889. 10,889. So you have eliminated the intercompany. You see, we have eliminated the investments against the what? The common stock, and we created the what? Non-controlling because they own only the what? 90%. 90%. So I'm going to continue this one. I'm going to continue this one on Wednesday. By Wednesday, I will complete marking of the word the exams. Then I will let you know where your score is. So any questions? Anyone has any questions? Any questions before we bring the class to an end?
Were you
Any
able to find
questions?
my homework?
Go ahead, Jason.
My microphone is not good. Can you hear me?
I can't hear you well. Your mic is, I think. Diane, please wait for me after class. Diane, if you can wait for me.
Yep.
Okay, so wait for me after class. Okay, so I remember a couple of 3 students didn't do the test. One has the permission already, so I have this thing. So no. I'll grade the homework and the test by the end of the tomorrow. I'll try to do that. Okay. Okay, so please have a nice day and see you back on Wednesday. Take care.